Hey there, we're live. Hello there. I'm Mitch Goldberg, and thank you so much for joining me. You're watching Be the Boss of Your Money. It's my live stream. It's all about helping you make better financial decisions for yourself, your family, for your business, and just to help you become the best possible financial version of yourself. Because let's face it, everything we do, everything has something to do with money. No matter what it is, it's a money decision. So we talk about that a lot. We talk about investing a lot. We talk about the stock market a lot. We talk about interest rates. We talk about inflation. We talk about the Federal Reserve. We talk about crypto. We talk about a lot of stuff. We talk about mortgages, home buying. I have guests on in these areas as well, and it's to help you figure out your way. I want to just address something real quick. A lot of people think that, oh, you're a financial advisor, that you know everything there is about every little thing that we could possibly ask you, and that you probably tell people what to do with their money. Okay, so first of all, I don't, obviously, I don't know everything, and no advisor can. People hit me up out of the blue all the time. What do you think of such and such a stock? Or they hit me up out of the blue. Hey, should I buy Tesla? I'm like, let me address that. I'm going to address that actually once we get into the show. And the other thing is, you know, when we give advice, we have to be careful as a financial advisor. We don't just like to throw out names. I know you think like, well, in CNBC or whatever other news channel, people are throwing out names. You should buy this. You should buy that. Be careful. I've seen a lot of people lose a lot of money uh, buying what the talking heads are talking about. Often these are just stocks that some fund manager is buying for the mutual fund that they manage. And if it's a large cap growth mutual fund, for example, they're not recommending stocks that are specific for you. They're recommending stocks that are specific for somebody, a generic person who just wants large cap exposure. And that fund manager could be buying 50 or more stocks in the fund that he or she manages. So if the one stock they blurt out on TV doesn't work out or in some news article, they have many others to fall back on. You have to understand that just because they say you should buy Microsoft, for example, doesn't mean it's right for you. Now, it's a great company and it's been a home run of a lifetime. How does it do going forward? Maybe it continues. But the point is, if I was a large cap fund manager and I said I like Microsoft right here, I'd buy it. That means I'd buy it for a diversified large cap mutual fund that fits into the portfolio of an end user investor. That's the retail investor, you and me, who's looking for large cap stock exposure. Okay. It doesn't mean it's a stock that's right for you. And you think, well, if the fund manager's buying it, it must be good. It doesn't mean it's good for you. The fund manager's buying lots of stocks, so they give themselves more opportunities to pick winners, and they give themselves more opportunities to not allow a big loser to blow a big hole in their portfolio and possibly ruin their financial future. I just have to say, diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. We've got a couple of things to talk about, and I see already Ross is out there. Hey, Mitchell Goldberg, looking good and sounding great on live video. Hey, thank you very much, Ross. This is like the one day I didn't turn on all my cameras. I'm just using camera one, but I've got the 810 mini Black Magic switcher and all that going. But whatever. Thank you very much, Ross. So nice to see you. So let's just put up the banner. And let's roll the intro. We're going to do a nice quick show today. I really want to make some important points and hit on some issues with municipal bonds that I've been asked about recently that I take it for granted. I think people know this, but they don't. So here we go. All right, nice to have you with us. I'm Mitch Goldberg, and you're watching my live stream. Be the boss of your money. Just want to take a note, make sure I don't forget to bring up a few topics. So I don't do like exhaustive notes or scripts. I don't read from a script. You're watching me live. I'm not This is about the extent of the notes that I take. I don't know if you can see that. All right. You can't even read it because my handwriting is like chicken scratch. But I basically hit the cameras. I hit the on button for the cameras, the lights, the mic, and we go. I've been doing this for a long time, over 30 years, and I really have a lot to share. I enjoy sharing it. I have had a lot of very unique experiences in the world of financial services. Um, I've worked at I've worked at big firms. I've worked at small firms. I've seen the best and worst in this industry, and I put it all together to bring you the absolute best and filter through the garbage. How's that? So let's just talk about the market first. We had like futures are up like 900 points this morning on the Dow Jones Industrial Average. You can't invest, by the way, directly into an index, but you could invest in a security that tracks or mimics an index. Dow is going to be indicated up 900 points, right? um, that was early in the morning after the inflation figures were released today, and they came in a little bit lower than expected. Wasn't like, I don't think it was like the biggest deal in the world. They came in a drop lower than expected. Investors just lost their shit and went nuts in the futures trading, sent stocks way up. There was also some good news from Boeing that they received a massive order from Continental Airlines. It's like hundreds of Boeing Y jets and 737s, Maxes, everything, on top of a big order of 100 jets ordered from an airline in India yesterday. So Boeing is all of a sudden back selling aircraft like crazy, getting orders, and they're just filling up their order book. The demand is insatiable right now for new aircraft that's cheaper to maintain and more fuel efficient, which is what Boeing did. And they finally have the recertification of their Max jets, their 7 Series Max jet. So we had good news. The market was going to be indicated like crazy up. But I was watching the futures this morning like, this is nuts, like up 700, 800, and 900 points. And my thinking was, if we could just close up 400 or 500 points for the day, that'll be pretty good. If we only close up a little bit like 100 or 200 or flat for the day, it's actually a pretty lousy close. It's what we wound up having. So I don't know about you, but I didn't do anything today. I didn't do any buying today. I didn't do any selling today. I just watched. The market is so crazy today, so over hyperactive, volatile between stocks and bonds, moving interest rates up and down today, mostly up a little bit. It didn't really pay to do anything. I don't feel like pressure to do something. I don't change my day one way or another because of a big up day or down day in the stock market. I basically do the same thing every day. I invest according to my clients' wishes, risk tolerance. I do this for myself. And then we do the financial planning aspect. You know, what's the next cycle of your life going to bring you? How do we get prepared for it? What smart money moves should we be making now? This is what it's really all about. The investments, my clients are pretty much set with the way their investments are. Like right now, I'm doing a lot of required minimum distributions for clients who have to take money out of their IRAs. You know, when you hit 72 now, the year that you turn 72, you have to start taking distributions out of your IRA. And I make sure that money is in cash in advance because I don't want to be forced to sell stocks or stock exchange traded funds or even bond funds into a down market. This year has been a terrible year for bonds. So bond funds are down a lot also. So people are like, how come my portfolio is not doing better? I thought it was more diversified between stocks and bonds. Well, usually the bond component of your portfolio holds up well, even goes up sometimes when there's a bear market for stocks. But that didn't happen this year. Bonds went down also. The whole market became a giant interest rate play. And I'll explain that in a moment. And while you're watching, if you wouldn't mind, give us a thumbs up, or a heart reaction or a wow reaction or applause, funny, whatever you want, depending on which social media platform you're watching from. It helps spread the word about the show to the rest of your social media friends and contacts, etc. And it helps, it just helps out the show and we can reach more people. It's all educational here, right? This isn't some infomercial. This is really an educational show. And if you have any questions, definitely ask me in the comments. That's what the comments are for. So let's see those questions, guys. Let's see them. Or if you just want to say hi or, put your favorite emoji in in the comments. That's always good for engagement as well for the show. All right. So we had the market up a lot. Market was up then during the day. Once the market opened, and early in the day, it was up about 700 points. And then slowly but surely, the Dow actually went negative for a little bit. And it finished up a little bit. What's it all mean? It means that inflation is still high. It's still going up. It's just not going up as much. It means that the Federal Reserve still has a lot of work to do. Oh, I got a heart out there. Thank you, Ross. I appreciate that. Right back at you, brother. And it also means that investors just are sick of playing Charlie Brown and Lucy with the football. And I posted this the other day. I had a video of Charlie Brown running to kick the ball to he's running, he's going to kick the ball. Lucy's holding the football and Charlie Brown's going to run and kick it. And every time he does it, Lucy pulls the ball away and he goes flying up in the air and lands flat on his back. And he falls for it every single time. And that's what I feel like with the market. So for those investors who ran out and decided, I've got to buy everything, I'm going to just run out there and buy, you were probably down on literally everything you purchased today. If you bought this morning on this, on this wonderful inflation report, which I don't think was so wonderful. And, so once again, you got the rug pulled out from under you, got the football pulled away. So I think that's what's happening again. And I just think that if you want to invest because, now's a great time to invest, I actually think that's like, I don't think that's a good thing. I don't think like, the market's down now, this is when you want to invest. Or as some of the guys used to work with a long time ago when I got into the business, you're supposed to buy when they're down. No. You don't just buy shit when it's down because you could actually be buying bad stuff. All right. You invest when it's right for you. Now, for example, if today I had money going into the market from my 401k plan contribution, so be it. I'm not going to stop my 401k contribution from going in today because the market's up and down. I'm doing that because based on my time horizon, my risk tolerance, I want that money going in every pay period, typically every month. That's what we want. It has nothing to do with if it's a good time to invest or not, because most of the time when people think it's a good time to invest that I see, it's not always such a good time, and vice versa. All right, so I just want to get that out of the way. I don't like when people say, now is a great time to invest. Why is it a great time to invest? Well, stocks are down. They're down this much. I remember when Meta, which was called Facebook, hit 200. People were all over the airwaves say, "Oh, Meta, $200. You got to own the stock, down from over 300." And now it's in the low 100s. Never underestimate how low a stock could go. All right. And to you, the individual investor, you might see a bargain, but to an institutional investor who's got tons of money under management, selling one stock, even at a massive loss, is nothing for them. It's a tiny little part of their portfolio. And by the time it's down, it's so meaningless. They don't even want it in their portfolio. All right. I hope I'm making sense. I'm just trying to explain to you how this business works. All right. So let's move on. I think Ross has a question out there. Trending up is a better sign of future rise. Yeah. I mean, if it's a persistent trend up, right now we don't really have a trend. You're looking at 200 moving day averages, things like that. We don't really have any particular trend. If anything, the trend for the market has been pretty lousy. But again, I'm not making my investment decisions based whether or not if there's a good trend or not. And I think when you want to get into that kind of thing, market timing, be my guest, give it a shot. I think probably a lot of people say, there's no such thing as a good market timer. The problem with being a good market timer is that once you make a few profitable trades with market timing, people tend to think that they're pretty good at it. So if you flip a coin and you keep calling heads and you keep getting heads, you're going to start to think you're a pretty good coin flipper. Like, wow, I'm good at flipping coin. I call heads and it comes up heads. I'm pretty good. But your odds are still only 50-50. So if you flip a coin and it comes up heads If you flip a coin 10 times and it comes up heads 9 times and tails once, what are your odds of the next time being, calling heads and being right? A lot of you could say that's a 90% chance of being right. No, it's still 50-50. The next 20 times in a row, you could come up tails. It's basically random, but over thousands of coin tosses, it'll come out to 50-50, and you'll find out. It's like trying to win consistently in tic-tac-toe. Ross agrees, said 50-50. I think you said 50-50 probably before I did. So I'm giving you credit for that, man. Thank you very much. And so that's the problem with market timing. All you have to do is be wrong once, and you basically obliterate all the gains you had before. This is a problem that people have in bull markets. You may have seen this, where you're pretty hot, you're making money in a bull market, so you sell the tech stock that went up a lot, you buy another tech stock that you think is cheaper, and you keep going back and forth, and you're buying another stock. So by the end of the year, yeah, you made money. Your account could be up, right? It could be up a lot. You've got to pay all those capital gains taxes. And then the next year, the market goes down, and you're like, I paid all those capital gains taxes, and yet my account is now worth less than it was last year. It's even compounded more by the fact that that you had to pay all the capital gains taxes. I've seen that time and time again. And this is why managing your stock money, your assets, is not as easy as it sounds. I know this isn't a problem for a lot of you in IRAs, tax sheltered accounts, but how many people are really interested in trading stocks in their IRA? I know someone's going to call up and say, oh, I love trading it. A guy I know trades it, and this guy I know, and then my brother-in-law trades it. It's still a very small percentage of you who are actually actively trading in your IRA, because most of you realize that that is truly money you need to retire one day. All right. So anyway, low inflation, stocks shoot up, stocks shoot down, up only a little bit. Let's take a look at how everything did today. All right. Pop myself up here. All right. Dow up a measly 100 points. I would just want to say, big deal. NASDAQ up 1%. It was up almost 4% earlier. S&P up 29 points. That's 0.73%. Gold up a little bit. Well, if inflation was going to be down, gold should be down, right? Decent day for oil. Oil was up yesterday. It's up today, starting to come back a little bit. 10-year yield still at 3.5%. No big deal. The VIX is off a little bit. Doesn't really tell me anything except that, let me get rid of that. Except that the stock market was up a lot, gave up the gains, which is just like terrible. I'd rather start the day down and finish strong than start strong and finish down. They're just completely different animals, and it's just, to me, this is just an ugly close. All right. Yields were off a little bit across the board. I had this debate with my partner, Bobby, today about yields. So yields were off a little bit, and I said to him, well, I bought I've been buying treasury bills. I talk about it on the show, for the right clients, and now yields are a little bit lower. Like now, all of a sudden, the 7-year, the 5-year, the 3-year are below 4%, and the 1 year was 4.7. Now it's only 4.6. You're still getting the best deal, I think, in the 6-month yield. There's a risk to going to the 6-month yield because it'll mature in 6 months, and rates could go lower, and you'll wish you bought, let's say, the 3-year at 3.95%. Okay. But the debate with my partner was this. I'm like, okay, so I bought bonds. I'm glad I did. Yields are down. And his thing was, well, the Fed's expected to raise interest rates tomorrow. So the Fed meets tomorrow. I'm going to tie all this together, but the Fed meets tomorrow, and they're expected to raise short-term rates 0.5%. The last 4 times the Fed raised rates, it was each 0.75%, which is huge to have 4.75% rate hikes in a row. We've never had that ever, okay? 0.5% is what's expected tomorrow, and then we'll see. And then we'll see what the Fed has to say. Fed Chair Jerome Powell will see what he has to say about future Fed policy. Of course, we know that he's always subject to change depending on how the economic statistics, how the economic stats come out. So whatever he says, observe, but don't act. Take it with a grain of salt. That's what I like to say. So he'll raise rates. So therefore, you would expect that yields will go up on short-term bonds tomorrow. Prices will go down. But I think it's factored in. I think we all expect a half a point increase tomorrow in short-term interest rates and the rates that the Fed can control, the federal funds rate. I don't really expect much downside in bonds tomorrow, short-term. Bobby expects a little. We're going to find out. But either way, we both are doing the same thing. When it's the right time for the client to buy a treasury bill or any other security, then it's the right time. It's not the wrong time. It's the right time. So there you go. Like, that's it's not the only thing I preach. I mean, I did hold on to cash for a very long time in the bond component of people's accounts because I was concerned about duration risk, meaning if interest rates would go up, it would knock bonds down a lot. And I'm glad I made that move, but I'm not making those moves day to day or week to week. They're really more long-term moves. In fact, when I buy a stock for a client, I expect to be in it for years, not weeks or months or certainly hours. Okay. All right. Anyway, so we had the lower inflation numbers today. People are thinking the Fed could actually raise rates or stop raising rates a little sooner. You're expected to go a half a point tomorrow, a quarter point in February, a quarter point in March. The Fed meets every 6 weeks, not every month, by the way. We'll see what the future brings. But the top rate, one of the Fed governors in St. Louis, James Bullard, said we could see the top rate, the end terminal rate of what the Fed's going to raise rates to at 6 or 7%. But the betting now is it'll be about 5%. It was a little over 5%. Now it's like 5%. When the Fed raises rates tomorrow, it'll go from 4 to about 4.5% on their target rate. And then, Fed funds rate, and maybe a quarter point to get to 5. It's all speculation, guys. And if you're making your like lifelong investing based on this stuff, I really do think you're making a mistake because you just don't know. All right. One thing you could do is just dollar cost average your investments into the market. You could dollar cost average your investments out of the market. This way, when you dollar cost in, you're always going to buy more of shares when they're down, less when shares are up. And when you dollar cost average, you'll always, sell more when shares are up and sell less. You'll sell less when shares are up and sell more when shares are down. But there's a lot of ways to skin this cat. I'm not saying they're all great. We have to find the way that's best for you. Okay. So what's next for the Fed? We'll see what Powell has to say at around 2:15. He goes through his question and answer period, and he's going to be asked a lot of tough questions. And everyone's looking for that one phrase or a buzzword where he says, we're probably getting to the end of interest rate hikes. We want to pause soon and see how what we've done so far affects the economy. Will we hear that or in some cryptic way tomorrow? We don't know. It's another reason why stocks didn't go up much today, even though inflation numbers came in lower than expected. All right. So the performance chase I like to talk about. Investors of all stripes, including institutional investors, just like your typical fund manager, right, are very negative. They've lightened up tremendously on interest rate sensitive sectors like banks, like technology. They're underinvested. They're heavily invested in the types of securities that could hold up or at least could do well or at least hold up in a slowing economy or in a recession. And if things do better in the economy, meaning inflation comes in a bit lower than expected, the Fed could start easing off on the brakes. You could start to see the economy go up. You could see stocks go up. You could see cyclical stocks that are sensitive to the vagaries, the ups and downs of the economy. They could go up. That could catch a lot of fund managers off guard. If that happens, they're going to start having to deploy cash. Okay, they're going to start chasing stocks. The stock goes from 100 to 120. Oh, now the fund managers have to buy it. And they have to buy the stocks that are doing well this year for window dressing, meaning if you're a fund manager, you're not going to want to show the losers on your books. You're going to want to show that you were investing in the winners, even though it wasn't reflected in your annual performance. That's performance chasing. And when the chase is on, it's a very powerful force. It makes the winners go up more, it makes the losers go down more. And we could see that right into January and February of this year also. So a lot of investors are optimistic short term for the year end this year and the early part of next year. All right, now let's talk about municipal bonds, and we're going to get going, okay? There are two, I have my list here. There's two downsides to municipal bond interest. Now, I know a lot of you think, oh, municipal bond interest is great because it's tax-free, and it's true. If you buy a municipal bond in your state, you don't pay federal taxes and you don't pay state income taxes on the interest. Now, if you buy the bond, a municipal bond issued in a state that you don't live in, then you'll be subject to state income taxes. I know there are a couple of states, like 7 states, that don't have a state income tax, but I'm not sure what they do with municipal interest. But I can tell you from a federal level on a tax return, even though municipal bond interest typically is tax-free, it does raise your modified adjusted gross income, meaning that is taken into consideration as making more money, which could impact the taxes you may or may not pay on Social Security, and it could raise the premium for Medicare. Okay, so that's the downside to municipal bond interest. It's not as tax-free as you think if earning tax-free income is going to hurt your Social Security by taxing it, by making it more taxable, or making a bigger portion of it taxable, and by raising your Medicare supplements, your premiums for the supplements, okay, for Part B in particular, and the, that for Part B. So that's what you need to know about municipal bonds. So that's about it for today. If you got value out of this and you enjoyed it, please give us a thumbs up. Say hi in the comments. I'm going to get going. I'll be back tomorrow. Thank you so much and have a great night.